cost volume profit analysis allows companies to understand how much of a certain product they should make. This is also sometimes called break-even analysis. In order to do this type of analysis, you have to understand your sales price and some costs, specifically your variable and fixed costs. Remember, variable costs are costs that change as production goes up or down. Fixed costs do not change with production levels. An example of variable cost would be employee man hours and labor. An example of a fixed cost would be factory rent. Break-even analysis is all about figuring out what's called contribution margin. You see, contribution profit is a type of profit similar to throughput profit, but not quite the same. You see, contribution profit is sales minus variable costs. Remember, throughput was sales minus direct costs. There are some costs that will be variable costs, but they will not be direct costs, such as your utility payment. If you use the factory this month, your utility payment is going to be higher than if you didn't use the factory. But it's not a direct cost because you cannot directly link that utility payment to the product that you made. Now, contribution margin is just like gross margin or net margin that we talked about in financial accounting. Remember, all that is the type of profit divided by the sales. So in this case, contribution profit divided by sales would give you contribution margin. In order to find your break-even number, which is what most of this analysis is all about, you divide your fixed costs by your contribution margin in order to find how much in total sales you have to sell in order to break even. That just means you cover all your costs and you make $0 in profit. It shouldn't be a goal, but now at least you know exactly how much you have to reach in order just to be able to take any money home for your investors whatsoever. That's a lot, so let's run with an example. Let's say that I run an airline company. You see, airlines are very high fixed costs. In order to run an airline, you have to buy a lot of planes. Planes aren't cheap. However, they have low variable costs. While pilots get paid a good amount, relative to the big planes they fly, they're not that expensive. So pilot salaries and the peanuts they feed you and the jet fuel really isn't that much money when it comes down to buying a plane. So this will be a very good example of what should a break-even analysis look like for an airline company. Let's say that my average ticket sells for $100 per ticket. My variable cost of serving that one passenger who buys that ticket is $10 per ticket, but my fixed costs are $900,000. How many tickets do I need to sell in order to break even? This is where cost volume profit analysis can really help us. The first step is to find the contribution profit. Remember, contribution profit is just the sales price minus our variable costs. So $100 sales per ticket minus those $10 it costs to service those people, those variable costs, gives us $90 in contribution profit. The next step is to find contribution margin, which is just that contribution profit divided by our sales. So $90 divided by 100 gives us 90%. That's our contribution margin. So with that contribution margin number, we can now find break even by dividing our fixed costs by that contribution margin. That $900,000 in fixed costs divided by 90% gives us $1 million in total sales. Now that's how much sales revenue we have to make, not how many tickets we have to sell. In order to find out how many tickets we have to sell, we divide that total revenue number by our average ticket price. So 1 million divided by $100. That gives us 10,000 total tickets. So what does all this mean? This means in order for us to make any profit next year, we have to sell at least 10,000 tickets at an average cost or at average price of $100 per ticket. Okay, is that possible? I don't know. You see, I don't know who our competitors are. I don't know what the demand is for these tickets. I don't know if we only have one plane or if we have 100 planes. All that kind of information will help you make the better decision of, is this going to be profitable or is this not going to be profitable? You see, this cost volume profit analysis, also known as the break-even analysis, allows you to make these kind of decisions if you have good context of the business. So you can evaluate maybe new products that you're looking to launch, or new businesses you're looking to acquire, or even new industries that you're looking to enter. So this is a super handy tool for you to figure out a lot of different aspects of life when it comes down to the business world.